Oh, welcome to the Smart Property Investment Seminar, Building Wealth Through Real Estate. I'm the host of this section, Aaron Brewer, a mortgage broker, and I'm partnering with Steve and Vicky, which is the professionals that we're joined with today. A little bit of an introduction about me and my experience as a broker. I work with a large type of audience. That can be from, first home buyers, second home buyers, upgraders, investors, being that first time investors, second time, multiple time investors, people that buy inside of trusts, inside of companies, people that lend in commercial and business as well. So I feel like I've got a broad range of just different experiences that I've had as a broker. And I've helped a lot of clients to do that. Hundreds of clients is now within WA, across the Eastern Seaboard, Victoria, Melbourne, Tasmania, Adelaide, South Australia. So yeah, I work with a lot of type of people. My core type of person that I kind of am the most passionate about working with is Gen Zs and millennials. I'm really driven to help Gen Zs and millennials to help build their wealth through property. Property is such an amazing tool to help build wealth, coinciding with other forms of investing. And I just really am passionate about helping them understand that and to help, I guess, feel more confident with their decisions around finance and to have someone to talk to about all things related to finance and investing. My role with clients as a mortgage broker is to help them find the best type of home loans that suit them. I'm not just your standard run-of-the-mill broker that's here to get you, the most dirt cheap rate that you can see on the market. Anybody can go on, ratecomparison.com and have a look at what the dirt cheap options are. My goal is to help you understand why a certain home loan might be beneficial for what you're trying to do and understanding your situation and where you're at to help guide you towards what might be the right lending product. And sometimes that's with a bank. It might be a big bank. It might be a second tier bank, a third tier bank, a non-bank, something like that. It's more or less to help match you with that right strategy, I guess. And the biggest thing that I love that's part of my role is also working with other professionals to help you build wealth. So working with buyers agents, just like Steve, accountants like Vicky, financial planners, solicitors, lawyers, everyone that I can, I like to surround myself with to kind of give you the experience and turnkey that you'd need to start from basically nothing and to help build yourself, more education around wealth and investing, but also to feel confident with you've got a team of people to help you out because obviously that's not your profession, it's ours. What I'm going to cover today in my side of this seminar is debt recycling. So, how to leverage your home loan for investments and talking about deductible and non deductible debts. Cash flow, so understanding the income versus expenses from owning an investment property. Borrowing power, now this is the most talked about topic and probably the most common question I get is how much can you borrow? Borrowing structures, so individual trust companies, SMSF we're going to cover, and then also just some, I guess, real life examples of investment scenarios, just so you've got some amount of numbers to take away at buying for a $500,000 property for investment and also for a $750,000 property, which is probably majority of the market. Debt recycling. This one can be a little bit in depth, but I want to try and make it as simple as possible for today's discussion. So debt recycling is just using the existing equity in your property to help fund an investment property purchase or just any investing while keeping your debt level tax efficient. So the ideal circumstance is that you convert non-deductible debt, which is like an owner-occupier home loan or any type of home loan that isn't investment, and making it or changing it into deductible debt for investment purpose. And then looking at redirecting any rental income or income that you might create from the investment and any tax savings or gearing or anything like that into paying down owner occupier debt. So our goal in investing just more broadly is to have as little non-deductible debt because it serves no purpose and having as much deductible debt as possible. So this is an example of how debt recycling can impact you in a similar situation here, where before debt recycling, you might have a $500,000 home loan and you might have $100,000 sitting in the offset account attached to that home loan. So you're getting the effect of that $100,000 saving you in interest. But what you could do is instead of taking that $100,000 of savings and going to invest it and use the cold hard cash, The debt recycling strategy would be that we take the $100,000 and we pay it into the home loan, which is in this example attached to our owner occupied property and has no deductibility. We pay the home loan down by $100,000. So the home loan goes to $400,000. And then we actually take out another loan from the bank, but for investment purpose. So it's an investment loan, a split loan facility, and with that $100,000, we get the $100,000 cash back. Now we've got a $100,000 loan attached to it, and we take that $100,000 cash, and now we go and invest. And once we've been able to invest and it's producing income, this $100,000 investment loan now can become tax deductible as well. Cash flow. Now, this is the most important part of investing because you can buy all the property in the world and increase your asset position, get lots of equity. But unless you've got the cash flow to hold on to the properties, that's when we can start getting into real strife with having to sell properties because we can't afford to hold on to them anymore. Positive and negative cash flow. So, positive, as the name might suggest, your rental income that you're receiving is much more than your expenses. So you're in a surplus of funds. And in this case, you'll be making money and you probably be paying tax on that money as well, which is not necessarily a bad thing. Negative. Now, this is where negative gearing can sort of summarize as well as your rental income is not quite as much as the expenses. The expenses for the property, which you might include interest, it might include strata, it might include any cost to maintain the property, are more than the rental income you're getting. And then the difference in between, which is a loss, can provide the tax benefits. And this is where you really need to speak to a tax professional like Vicky to understand how those deductions can play out and also how to maximize those deductions as well. Now, the budgeting for the expenses side of things is not only just the loan that you're getting to repay that investment property or that investment, but also the things like property management, any fees that come with property management services as well, maintenance on the property, insurance on the property, vacancy periods. These are all the things that are untalked about when you're investing in property. These are the things that somebody has to pay for. And yes, the rent will cover some portion of it, but in most cases, especially with a high interest rate environment, then the rent is not going to quite cover it. And that's where we can get into that negative cash flow environment. So you've got to make up the difference. Understanding your borrowing power. This is, as I said, the most common question I'll get from people is, what can I borrow? And it's such a very broad question and usually comes with a broad answer as well. How much you can borrow gets split into two sides that I like to discuss with people. The borrowing capacity, or how much you can service to the bank, is only predicated on your income and your expenses. So that equals your borrowing capacity. How much you've got coming in, how much you've got going out the door. The other side of that is the contribution you need. So that might come from when you're buying a property, how much savings you need. Is it 20%, 10%? All this sort of thing. Is it savings or is it equity as well? And that will tell you how much you can buy for, because to buy a certain property, you need a certain amount of contribution as well as the borrowing capacity. So we have to have this balance between how much we can borrow from the bank and how much we need as a minimum to be able to do the transaction. And this is the most common question I'll get from people. And maybe the misunderstanding that's out there is, oh, I'll just borrow that amount of money from the bank. No, you need to satisfy both parts of that. And that's really where, the conversation and education around finance comes in. As I've said here, typically you'll need a 20% deposit. So that's got to be savings or equity to avoid paying lender's mortgage insurance. Otherwise, if you want to pay lender's mortgage insurance, you'll need a minimum of 8%, including the lender's mortgage insurance. And this could come from cash that you've got in savings or equity in your own home. Ways that you can actually boost your borrowing power. This one is, it could be common knowledge, but the most efficient way to boost your borrowing power is always going to be pay off non-deductible debt first. So high interest credit cards, personal loans, car loans, step pay, afterpay, all those sort of things can really start to draw from your borrowing capacity. So if you can, and you're in a position to, paying off those debts can help you boost a lot more of your borrowing power with just doing the bare minimum. Then the next part of it is paying down non-deductible debt. So typically an owner-occupier home loan. Then other things can can come into play. And this is where the skill of a broker comes in as well around policy. It can be including things like your bonuses you might get every year, commissions you might receive, overtime, allowances. All those things can help boost above just your base salary. The untalked about thing is just increasing your income. Are there ways you can negotiate a pay raise? Could you look for a different job that could help you improve your income? Yes, reducing expenses is great and it can help you to boost your borrowing power, but going out and actually getting paid more can also do that as well. And then the last part of that is whenever you're looking at buying an investment property specifically, then you can look at using the rental income you may get from that property as proposed income to help boost the borrowing power as well. Paying off existing debts like credit cards, car loans helps. Even yes, HEX debts can increase your borrowing power. However, also if it's coming from the savings that you're using, that can potentially affect how much you need as your contribution. So speak to a broker to understand that before you go out and do it. And you might think, yep, I'm going to go pay X amount off my HEX and close it. But it would be best to just speak to a broker before you do something like that so that they can run a scenario for you to make sure it's going to work. Borrowing structures. Now, this is the juicy part. There are four main structures when we buy property and lend for it for the purchasing of investment property. Usually it's your individual name, so that could be two people or one person buying. It could be under a trust type structure. It could be under a company, so proprietary limited, or it could be a self-managed super fund potentially. In your individual name, it is much, much simpler. There's fewer costs. You get the benefit of the negative gearing, so your expenses outweigh the income. You can claim some of the difference in that. The cons is it uses your personal borrowing capacity. So your personal borrowing capacity is limited by your income and your expenses. So using your individual name can chew that up quicker. As a trust structure, you get the asset protection. It's a separate entity. There's the difference from you as a person and you as an entity. You can split income through different types of trusts as well. So people can take different shares of income to help with tax. It also separates the personal borrowing and trust borrowing. And this is something that a lot of people really like about trust borrowing or buying inside of an entity is the bank, what they're concerned about is only that entity's ability to meet the repayments. Obviously, you're going to be chipping into some of the income, but they're only looking at assessing that. So when it comes to your own borrowing capacity, things like a debt inside of a trust won't show up when you go to do your own lending, but there are certain things that you need to tick off that are extra to be able to do that. The bank just exclude those type of loans. The cons is obviously setup costs, higher setup costs to set the trust up, and the compliance requirements around it with your accountant, and then ongoing costs of maintaining the trust as well. It can limit your borrowing options when you're investing inside of just your personal name. You may have a pool of 30 different lenders that you could use because they all accept those type of applications. As a trust structure, not every lender does, so you limit your pool of potential lending options, which means that you might only have a few to sort of choose from. And there's no personal negative gearing. So inside of a trust structure, you can't claim a personal loss for any of the stuff that's going on inside of it. You need to speak to the accountant about how you can claim that. As a company, again, you get the asset protection. You also get the company tax rate. So for most companies that are operating as an investment, you can claim that 30% tax rate. And it also gets the separation between yourself as a person and your borrowing capacity, and then also the company or the entity as well. One of the benefits, again, you need to speak to your accountant about which entity, if that is the case for you, is right for you because they have certain benefits in terms of how they hold income and stuff like that. Um, Again, the cons of this is the high setup costs, ongoing costs, limited borrowing options based on who will take you on as a lender, and also no personal negative gearing. Self-managed super fund is one that's not talked about as much. And this is a really important one to discuss with your accountant as well, because you need to be at a certain age and stage to be able to even consider this option. Again, it offers asset protection that has one of the lowest tax environments inside of Australia, which is 15% flat tax rate. And again, it separates your personal borrowing and the super funds borrowing as well. This one may have one of the highest setup costs and ongoing compliance costs for super. And again, no personal negative gearing. Um, Absolutely have to speak to your accountant on which one is the right option for you. And too often, when I'm working with clients, and it may be that I've been introduced at a later stage or something like that, and somebody has purchased the property in the wrong structure, potentially for their situation. And once you've done it, then it costs thousands to then go and change it. You have to buy it off of yourself and all this sort of thing. You can pay stamp duty again, and you can have increased costs. So I highly recommend before you make the purchase, make an offer, you have to speak to your accountant about which is the right structure for me. Here's some examples of different investment properties and different price points to just give you some hard numbers to kind of work with. So on the left-hand side, we've got a purchase of a 500K property. So the scenario is buying a 500K property. We're going to be putting down a 20% deposit. So the loan to value ratio is going to be about 80%. And we're going to go for an interest-only loan that might be at 6.72%. The total amount of loan we need from the bank is $400,000, which is the 80% LVR. We need a deposit of 100 grand plus stamp duty and costs. The 100 grand might come from savings. In this example, it's from savings. It could also come from existing equity in a property, but then we have to allow for the fact that you have additional costs by borrowing that 100,000 instead of using it as cash. And the interest only repayment on a loan like that at 6.72 would be somewhere around 2,240 per month. The estimated rent from the property that you might get, I've used a pretty conservative estimate of 4.5% yield, might be $450 a week. So there's $1,950 of income that you're getting, and you're paying repayments of interest only at 2,240. So there's a shortfall of $290 per month. And that's not even including things like maintenance, insurance, rental management costs. So you're already short $290 a month, which has got to come from your pocket to put towards it. So that's part of a negative scenario because you're still putting money towards it, but you can claim the deduction when speaking with your accountant about that shortfall that's coming from you. The other example here is a 750K property. 80% LVR again, interest only loan at 6.72%. Now you're going to need around $600,000 from the bank as a loan, and you're going to need a deposit of $150,000 plus stamp duty and costs. The interest only repayment on that is $3,360 per month, and the estimated rent at 4.5% yield is somewhere around $650 a week, so 2816 a month. The net shortfall, so your contribution that you're going to have to put up, is going to be $544 a month. And that again is excluding property expenses, maintenance, insurance, and management fees. So you can see here from both of these examples, you're having to chip in money every month to hold on to it. So you just have to be prepared in your budget as well to be able to actually fork that out, because in the majority of cases where I've seen that people lose money in property, it's because they didn't have this in their budget along with their everyday costs for living, their rental situation or their own mortgage. So you really need to almost backtrack and be like, okay, how much do I have in my budget to be able to put towards something like that? And do I have buffers in place to allow for the fact that it might not be rented out at all points of time? There may be things that come up to help maintain the property and big expenses. So you just have to be very wise that you need a buffer in place, and also you need to be really on point with your budget to make sure that this is going to work for you. The key consideration here that we talked about, if that deposit of the $100,000 is coming from equity, then you also need to factor in that although you've got this $2,240 a month in repayments for this 500K property, if you accessed equity, you're still borrowing that money from the bank. So then you've got a $100,000 loan that you're going to have to repay as well. So in this example, let's say you did release $100,000 of equity at that same interest rate, that's going to cost you on its own an extra $560 a month in repayments as well. So then you're going to have the 2240 plus the 560 a month to be able to hold on to that property that you've got to come up with too. So the rental income in this impact is going to also have to cover the loan plus the equity loan plus the insurance management maintenance. So this really is key to sit down and actually work out, okay, how much am I going to be able to put towards this to make sure I can afford to hold on to this property? One of the biggest things when structuring the right lending options around buying an investment property is there's kind of two key ways to do it. One that's really popularized by the banks because they like to do it, which is a cross-secured model or cross-collateralization. And in this example, let's say you had a property at $1 million worth of value. It's got a 400K home loan in it. So the equity on that property that could be accessed could be up to $800,000, which is the 400K loan minus the 400K of equity that's available. What the banks will often do with this is that they will say you want to go out and buy this 500K property. They'll say, all right, well, we can lend you the full amount of the property plus the stamp duty plus the cost and everything like that. So you can get a loan on that property of 521,500, even though it's only worth 500,000. And what we're going to do is we're just going to secure that difference of 80% of the home's value, which is the safe mark for them, with your existing property. But you'll have a 100% loan on this new property. It doesn't change anything materially, but what it does is restrict your options moving forward because you have to be with the same bank. Both of those properties have to be with the same bank. That bank may not have the best options for investment. It might have different options for owner occupier that aren't as good as another bank. So you're stuck with that same bank. The bank has two properties on their balance sheet, which they love because it's lots of security they could access. And you have limited options around selling the property. So if you sold this $500,000 property, you've got a $521,000 loan attached to it. So you have to be able to shortfall that somehow. Or if you sold your $1 million property to go and buy an upgrade or something like that, then you've got to be able to release that loan. You've got to come up with the difference and get it down to 80% as well. Versus the way that I would love to do it with people and that I try to do it working with them as early as possible is that we have the $1 million property. We've only got a $400,000 home loan, same as that. Instead of loaning 100% of the property's value on the other property, we actually do an equity release first. So we get a new loan out of the 121,500, which is the stamp duty plus cost plus deposit, all that sort of thing that we need. We've got that sitting in that account separately. And then we go out and do the purchase for an 80% loan. So these could be with two different banks. You could stay with your original bank that you're with at the moment at the top. And then this second property or the property that you do buy could be with a different bank as well. And that means that those properties are both standalone because you could buy and sell and do whatever you wanted with them separately. So it just gives you more options. Cross securing is not necessarily a bad option. I do have clients that I do recommend it for because of the speed. Equity release, you'd have to do all of that first before you buy the property. So there's different instances where it's right and wrong, but that's why it's important to just chat with a broker as early as possible to make sure you get it right and that you know kind of what's going on in your situation. Cool. Closing tips. Work with a broker as early as possible to maximize your borrowing. You have to use professionals for this advice because what you read on Reddit or Facebook is not specific to you. So you need to have someone that understands, what you want to do and where you're heading to get the right advice. And focus on properties that align with your long-term goals. You're either aiming for growth or you're aiming for cash flow with the specific type of property, or maybe both. How can we work together? So clients, if you want to work with me, then you can book a consult to assess your position. So basically just to sit down and a chat about what you want to do and see if we're the right fit for each other. And then we can also leverage the expertise of people like Steve and Vicky to help work with you to get the right strategy and I guess to kind of form a bit of a team as to what you want to achieve. So if you want to work together, then you're more than welcome to scan the QR code, book yourself in for a time if it works, or send me an email or flick me a text or whatever, and we can just tee up a time. I hope this was informative. Again, finance is a topic that is very, very dry. I understand that not everyone wants to talk about finance, but I love it and I'm passionate about it. So if you want to work together and you feel like that's your jam, then yeah, feel free to drop me a line and we can chat about helping you out. Cheers.